Hello and welcome to our video on understanding risk in investing. Investing can be a great way to grow your wealth, but it's important to understand that all investment comes with some level of risk. In this video, we'll cover the basics of investment risk, how to assess your own risk tolerance, and strategies for managing risk in your portfolio. What is investment risk? Investment risk refers to the possibility that an investment will lose value or fail to meet your expectations. There are several types of risk that investors need to be aware of, including 1. Market risk. This is the risk that the overall market will decline, which can cause the value of your investments to drop. 2. Credit risk. This is the risk that a borrower will default on their debt obligations, which can cause bond prices to fall. 3. Inflation risk. This is a risk that inflation will erode the purchasing power of your investments over time. 4. Liquidity risk. This is the risk that you won't be able to sell your investments when you need to, or that you will have to sell them at a loss. Assessing your risk tolerance. Before you start investing, it's important to assess your own risk tolerance. This is the level of risk you are comfortable taking on in order to achieve your investment goals. Some factors that can influence your risk tolerance include 1. Age. Generally, younger investors have a longer investment horizon and can afford to take on more risk. 2. Financial situation. If you have a stable income and a large emergency fund, you may be more comfortable taking on more risk. 3. Investment goals. If you have a long-term investment goal, such as saving for retirement, you may be able to take on more risk. 4. Personality. Some investors are naturally risk-averse than others. Once you've assessed your risk tolerance, you can now start building an investment portfolio that matches your goal and risk tolerance. Strategies for managing investment risk. While it's impossible to eliminate all investment risk, there are several strategies you can use to manage it. Some of these strategies include 1. Diversification. This involves spreading your investment across different asset classes, such as stocks, bonds, and real estate. Diversification can help reduce the impact of market volatility on your portfolio. 2. Asset allocation. This involves determining the percentage of your portfolio that you allocate to different asset classes. A conservative investor may allocate more to bonds, while an aggressive investor may allocate more to stocks. 3. Dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of market conditions. This can help smooth out market volatility and reduce the impact of market timing on your returns. 4. Stop-loss orders. This involves setting a price at which you sell an investment if it drops below a certain level. This can help limit your losses if an investment declines in value. One important thing to keep in mind is that the level of risk you are comfortable taking on may change over time. For example, as you get closer to retirement, you may become more risk-averse because you have less time to recover from market downturns. On the other hand, if you are just starting out in your career, you may be more comfortable taking on more risk because you have a longer investment horizon. It's also important to understand that different types of investments come with different levels of risk. For example, stocks are generally considered to be riskier than bonds because they are more volatile and their prices can fluctuate more. However, stocks also have the potential to generate higher returns over the long term. Another way to manage risk in your portfolio is to regularly review and rebalance your investments. This involves selling some investments and buying others in order to maintain your desired asset allocation. For example, if your stocks have performed well and make up a larger percentage of your portfolio than you'd like, you may sell some of your stocks and buy more bonds or other investments to bring your portfolio back into balance. Finally, it's important to remember that investing always involves some level of risk, and there's no guaranteed way to make money in the markets. However, by understanding the different types of risk, assessing your own risk tolerance, and using strategies to manage risk, you can build a portfolio that matches your goals and helps you achieve long-term financial success. One important concept to understand is the relationship between risk and return. Generally speaking, investments that carry higher levels of risk also have the potential to generate higher returns. For example, stocks have historically offered higher returns than bonds, but they also come with greater risk. However, it's important to remember that past performance is not a guarantee of future results. Just because stocks have historically outperformed bonds doesn't mean they always will, and there's always the possibility of unexpected events that could impact the market. Another important thing to keep in mind is that not all risk can be diversified away. For example, if the entire stock market experiences a downturn, it's unlikely that any individual stock will be immune. However, by diversifying across different asset classes, you can reduce your exposure to specific types of risk, such as company-specific risk or industry-specific risk. It's also important to understand the concept of standard deviation, which is a measure of how much an investment returns have varied over time. Investments with higher standard deviations are generally considered to be riskier because their returns have been more volatile. Finally, it's important to consider the impact of fees and expenses on your investment returns. Even seemingly small fees, such as mutual fund expense ratios, can add up over time and significantly impact your returns. Overall, understanding investment risk is an important part of being a successful investor. By understanding the different types of risk, assessing your own risk tolerance, and using strategies to manage risk, you can build a portfolio that matches your goals and helps you achieve long-term financial success. One important point to keep in mind is that risk and return are not always directly proportional. While it's true that investments with higher levels of risk generally have the potential for higher returns, there are also investments that carry high levels of risk but offer relatively low returns, such as penny stocks or speculative real estate investments. It's important to carefully evaluate the potential risk and return of any investment before making a decision. Another important aspect of understanding investment risk is understanding the impact of inflation on your investments. Inflation can erode the purchasing power of your investments over time. So, it's important to consider investments that offer a return that exceeds the rate of inflation. For example, if inflation is running at 3%, you want to look for investments that offer at least a return of 3% just to keep pace with inflation. It's also important to understand the difference between systematic risk and unsystematic risk. Systematic risk is the risk that's inherent in the entire market, such as the risk of a recession or a major geopolitical event. Unsystematic risk, on the other hand, is the risk that's specific to a particular company or industry. By diversifying your investment across different sectors and asset classes, you can reduce your exposure to unsystematic risk. Finally, it's important to understand that risk is not the same thing as uncertainty. While there's always a certain amount of uncertainty when investing, that doesn't necessarily mean that there's a high level of risk. For example, investing in a diversified portfolio of low-cost index funds carries a relatively low level of risk, even though there's still some uncertainty about future market performance. Overall, understanding investment risk is an important part of being a successful investor. By understanding the different types of risk, assessing your own risk tolerance, and using strategies to manage risk, you can build a portfolio that matches your goals and helps you achieve long-term financial success. In conclusion, understanding investment risk is an important part of being a successful investor. By assessing your risk tolerance and using strategies to manage risk, you can build a portfolio that matches your goals and helps you achieve long-term financial success. Remember, investing always involves some level of risk, but with the right approach, you can minimize that risk and maximize your returns. Thank you for watching this video on understanding risk in investing. If you have any questions or comments, please leave them below. And don't forget to subscribe to our channel for more investment tips and advice.